Hi, this is Dr. Charlie Peterson. I'm the author of Dude, Where's My Profit? The Accounting Finally Makes Sense mini course. This video is a follow-up of my first video on depreciation, where I developed the numbers for the depreciation expense and the book value of the truck. You want to go back to that video to see how this is done. What I wanted to show you in this video is how it affects the T accounts and the financial statements. We know that we have a depreciation expense of $3,000 each year, and then we have a declining book value going from $10,000 down to $1,000. So let me show you how we would handle it for the financial statements for the first period. Alright, here we have our ledger. Now, we have a T account for truck and we have a T account for accumulated depreciation. Now notice one thing. Even though accumulated depreciation is an asset account, it increases as a credit and decreases as a debit, which is just the opposite of all the other assets, which increase as debits and decrease as credits. Accumulated depreciation is a takeaway account. It's going to be taking away from the value of the truck over the 3 years. We're going to continue to add $3,000 to this account. One of the things that is required in accounting is that if you have a long-term asset, we need to leave it on the financial statements at exactly what it cost throughout its life and as long as we have the asset. The way we decrease the value of the asset is we just keep adding to the accumulated depreciation account and then subtract it from the original cost of the asset. Accumulated depreciation and the truck are married for life. They go through life together, and any long-term asset has its own accumulated depreciation account. Now, in the previous page, we discovered that we had a depreciation expense of $3,000. All right, now this is an adjustment. We have got to do this at the end of our accounting period. We debit depreciation expense for $3,000, and we credit accumulated depreciation for $3,000. Now, this $3,000 goes into the income statement. The accumulated depreciation subtracted from the truck goes into the balance sheet. So here's our original cost less accumulated depreciation. The book value of that asset is now $7,000, and you add it in with all the other assets. Now, year number 2 is exactly the same thing, except now we're going to be doing our adjustment. Here's our $3,000, but we're adding an additional $3,000 to accumulated depreciation. So when that amount is subtracted from $10,000, we come down to a $4,000 book value. This is how it appears on the balance sheet. And for year number 3, it's the same. We have an adjustment for depreciation. We debit depreciation expense for $3,000, and we credit accumulated depreciation for $3,000. Now you'll notice we've accumulated $9,000 worth of depreciation. This will show on the balance sheet for year 3, 10,000 minus 9,000. We're down now to the salvage value of the truck. So that's how we basically handle it in the T accounts. Please tell people about my website, www.dudewheresmyprofit.com, and thank you for viewing.